At 2 a.m., in a quiet room most people will never see, a small group of officials change a single number. No cameras, no speeches, no applause. By the next morning, millions of lives are more expensive. Your rent, your job, your country's future. All because of one interest rate. And most people never notice when it happens. Right now, this matters more than it has in decades, because that number has been moving fast, faster than wages, faster than explanations, and the consequences are already showing up in places that don't look like finance at all. So, let's slow it down, strip it of jargon, and follow what really happens when that one rate changes. Imagine money as water. Not cash in your pocket, not numbers on an app, but water flowing through pipes. Some pipes go to businesses, some to governments, some to your mortgage, your credit card, your student loan. Now, imagine there's a master valve. That valve controls how hard the water pushes through the system. That valve is the interest rate. When it's low, water flows easily. Loans feel cheap, projects get funded, jobs appear, people take risks. When it's high, pressure drops, water slows, pipes strain, some stop flowing altogether. The strange part is this: almost no one chooses this valve directly. You don't vote on it, you don't negotiate it, you just live inside the consequences. And today, the valve is tight. Here's how it works in real life. Banks don't lend money because they're generous. They lend because it's profitable. But before a bank lends to you, it asks one question: what does money cost today? That cost is set upstream by central banks through a policy rate, a boring name for a powerful tool. If that rate is near zero, banks can borrow cheaply, so they lend cheaply. Mortgages feel affordable, businesses expand, startups multiply. If that rate rises, banks pay more to get money, so they pass the cost to you. Higher loan rates, stricter approvals, less forgiveness for mistakes. That's the direct path. But the real control happens indirectly. When rates rise, companies quietly change behavior. Hiring slows, projects get delayed, raises disappear, not because profits collapsed overnight, but because future money is suddenly worth less. This is where the math gets uncomfortable. $1 today is more valuable than $1 tomorrow. Interest rates decide how much more valuable. At 1%, waiting doesn't hurt much. At 7%, waiting is expensive. So companies stop waiting or stop investing entirely. That's why rate hikes are often described as cooling the economy. Cooling sounds gentle, like turning down a thermostat. But what actually cools first are people: construction workers, retail staff, young employees on temporary contracts. Not headlines, humans. There's a quiet irony here. Interest rates are raised to fight inflation, to make life cheaper in the long run. But in the short run, they make life harder for the people least protected from shocks. Higher rates mean higher monthly payments on things you already bought, on things you can't easily give up. Your house doesn't get smaller when rates rise. Your car doesn't become optional. Your student loan doesn't renegotiate. The bill just gets heavier. Meanwhile, there's another side of the story that rarely gets equal airtime. Governments are also borrowers. When rates were near zero, debt felt painless. Rolling over old loans was easy. Interest costs stayed manageable. When rates rise, governments pay more just to stand still. More tax money goes to interest, less goes to services, less goes to fixing things people already complain about. So the same rate meant to slow inflation quietly reshapes politics, budgets, and public trust. And here's the absurd part.
The system relies on everyone believing
Everything
this
is running
pain is
smoothly.
temporary,
Optimizing
that
the process
higher
now.
rates will
Efficiency
fix
is key.
things before they break them. But the system doesn't run on guarantees, it runs on timing. Raise rates too slowly, inflation spreads. Raise them too fast, something snaps. History is full of snaps. Housing crashes, debt crises, sudden recessions no one predicted 2 quarters earlier. Each time the explanation arrives after the damage. What makes this moment different is how many lives are already stretched thin. Savings rates are low, debt is high, costs are sticky, which means the margin for error is smaller than it looks on charts. There's also a quiet contradiction nobody likes to say out loud. High interest rates reward people who already have money. If you own assets, if you hold cash, if you can wait, higher rates pay you. If you rely on wages, if you borrow to live, if timing matters, higher rates punish you. The same number, different realities. That's how one interest rate can widen gaps without ever mentioning inequality. And still, it keeps moving. Because central banks don't have many tools, they have one main lever, and when inflation threatens credibility, they pull it. Not because it's fair, not because it's elegant, but because it's what they have. So the rate goes up, and quietly, decisions change. A business expansion that never happens, a family that delays having a child, a graduate who stays in a job they hate because debt is heavier now. None of this shows up in official statements, but it shapes the next decade. Which leads to the real question. If one number can control borrowing, spending, hiring, housing, government budgets, and personal freedom, who should control that number? And how much damage are we willing to accept in the name of stability? Because the valve will move again. And when it does, you'll feel it long before anyone explains it.